welcome to the Retirement Wealth Podcast. I'm so glad you're joining us today.
Yeah, it's great to have you here. We're diving into a topic that I think is on a lot of people's minds: how to avoid running out of money in retirement.
Absolutely. It's such an important concern, right? I mean, no one wants to face that fear of not having enough funds as they age.
Exactly. And the good news is, there are strategies we can discuss that can really help mitigate that risk.
Right. We'll be covering a few key points today, like understanding your retirement expenses, the importance of having a solid income plan, and maybe even some investment strategies to consider.
Plus, we'll talk about the role of Social Security and how to maximize those benefits. It can be a bit of a puzzle, but we're here to help you piece it together.
And let's not forget about the importance of healthcare costs. They can sneak up on you if you're not prepared.
That's a big one, and it's something a lot of people overlook when they're planning.
So whether you're just starting to think about retirement or you're already enjoying it, we hope you find some valuable insights today that can help you feel more secure and confident about your financial future.
Let's jump right in and start with understanding those retirement expenses. So, Emily, when we think about retirement planning today, it really feels different from even just a few years ago. I mean, with rising inflation and market volatility, it's like a perfect storm for many people approaching retirement.
Absolutely, David. I've been hearing a lot of concerns from listeners about their timelines. It seems like many folks are unsure whether they can actually retire when they want to.
Right, and that uncertainty can be pretty stressful. Just the other day, I spoke with a couple, let's call them Mark and Lisa. They were planning to retire in about 2 years, but with inflation eating into their savings, they're now considering pushing that date back.
That's tough. And inflation isn't just a number. It really impacts everyday life, right? I mean, groceries, gas, healthcare, all of that is more expensive now.
Exactly. And it's not just about the cost of living today. It's about how that cost will increase over time. For instance, if we look at healthcare costs, they're projected to rise significantly. A lot of retirees don't seem to realize that.
Oh, definitely. I read somewhere that a couple retiring today might need over $300,000 just for medical expenses in retirement. That's a huge chunk of change.
It is, and it's why planning for those costs is crucial. I had another client, let's say her name is Susan, who thought her Medicare coverage would handle everything. But when she looked closer, she realized there were major out-of-pocket expenses she hadn't planned for.
Wow, that's eye-opening. And I think a lot of people assume they'll be okay with Social Security. But with the current discussions around its sustainability, that's another layer of concern, isn't it?
Yes, it really is. And Social Security might not provide as much as many expect. I've worked with clients who've relied solely on it, only to find out it doesn't cover their basic needs. It's a wake-up call, for sure.
So what should people be thinking about when it comes to planning for these uncertainties?
Well, first off, it's about understanding your own situation. Like, do you have a diversified portfolio? Are you prepared for market volatility? Because right now, we're seeing fluctuations that can impact retirement savings pretty dramatically.
I can imagine that would be nerve-wracking. I mean, one day the market is up, and the next it's down. How do you help clients navigate that?
A lot of it comes down to having a solid strategy in place. For example, there's a couple I worked with, John and Sarah. They had most of their savings in stocks. When the market dipped, they panicked and sold at a loss. But with a balanced approach, they could have weathered that storm better.
Right, so it's about not just reacting to the market, but having a plan that accommodates those ups and downs.
Exactly. And let's not forget about tax efficiency. The tax landscape is changing, and it's important to understand how that affects your retirement income.
Oh, totally. I think many people don't realize how much taxes can eat into their retirement savings.
Right. I had a client, let's call him Tom, who had a great nest egg saved up, but he was withdrawing from his traditional IRA without considering the tax implications. He ended up in a higher tax bracket, which was a shock to him.
That's such a common oversight. So what can people do to minimize those tax impacts as they approach retirement?
Well, one strategy is considering Roth conversions. If you can pay taxes on some of your savings now, you might be able to withdraw tax-free later. It can make a significant difference in the long run.
That sounds smart. And it's not just about the numbers, is it? There's an emotional aspect to all of this, too.
Absolutely. Financial security in retirement brings peace of mind. I often tell clients that the emotional side of retirement planning is just as important as the numbers.
I can see that. I've talked to retirees who feel anxious about their finances, even if they have enough saved. It's almost like they carry that weight with them.
Exactly. And that's why having a clear plan can really help ease those worries. It gives people the confidence to enjoy their retirement without constantly stressing about money.
So true. And what about legacy planning? I imagine that's on a lot of people's minds too.
Definitely. Many people want to leave something behind for their children or grandchildren, but if they haven't planned for it, they might end up depleting their resources too soon.
Right, and that can lead to tough decisions later on. It's all interconnected, isn't it?
It really is. Everything from inflation to healthcare to taxes can impact not just the individual's retirement, but their family's future as well.
So, with all these factors in play, what's the best approach for someone to take right now?
Well, it starts with a comprehensive review of your financial situation, understanding where you stand and what adjustments might be necessary.
Sounds like it's a good time for everyone to take a step back and reassess their plans.
Exactly. And that leads us into some practical strategies that can help mitigate these risks and put people on a more secure path.
I'm looking forward to diving into those strategies.
So, Emily, when we talk about avoiding running out of money in retirement, one of the first things that comes to mind is asset allocation.
Right, that's such a crucial part of the puzzle. Can you break down what you mean by asset allocation?
Sure. Asset allocation is essentially how you divide your investments among different asset classes, like stocks, bonds, and cash. A common rule of thumb is the 70-30th rule, where you might allocate 70% to stocks for growth and 30% to bonds for stability. This can change based on your age, risk tolerance, and retirement goals.
So does that mean if I'm, say, 60 years old, I might want to shift that allocation a bit?
Exactly. As you get closer to retirement, many advisors recommend gradually shifting towards a more conservative allocation. You might move to something like 60-40ths or even 50-50 to protect your assets from market volatility.
And that makes sense. You want to safeguard what you've worked so hard to save, right?
Absolutely. And another key aspect is having a diversified portfolio. You don't want to put all your eggs in one basket. So it's not just about stocks and bonds, but also including real estate, maybe even some alternative investments.
Like what, for instance?
Well, some people look at real estate investment trusts, or REITs, which can provide income through dividends, or even investing in rental properties if they're comfortable with that. It's all about balancing risk and reward.
Got it. And speaking of income, let's talk about Social Security. How can someone optimize their benefits?
Great question. Timing is key here. If you can delay taking Social Security until, say, age 70, you can increase your benefits significantly, up to 8% annually, for each year you wait beyond your full retirement age.
Wow, that's a big difference. So if someone is eligible for, let's say, $2,000 a month at 67, waiting until 70 could give them, what, around $2? $640?
Exactly. That's a great calculation. And remember, there's also the option of spousal benefits, which can be beneficial for couples. One spouse might take their benefit early while the other waits, maximizing the total benefit over their lifetimes.
That's really smart. Now let's not forget about the withdrawal strategies. What's your take on the 4% rule?
The 4% rule is a classic guideline, suggesting that if you withdraw 4% of your portfolio each year, you're likely to have a sustainable income through a 30-year retirement. But, it's not one size fits all.
Why is that?
Well, market conditions change, and individual circumstances vary. For example, if you retire during a market downturn, withdrawing 4% could deplete your savings faster. Some people prefer the bucket strategy, where they segregate their assets into different buckets based on when they'll need the money.
Can you explain how that works?
Sure. You might have a short-term bucket for immediate needs, like cash or short-term bonds, then a medium-term bucket for income over the next 5 to 10 years, and finally a long-term bucket for growth, invested in stocks. This way, you're not forced to sell investments during a downturn.
That sounds like a more flexible approach.
It can be, for sure. Now, let's talk a little about tax-advantaged accounts, like 401(k), S, and IRAs. It's important to understand how to use these effectively.
Right. I know with a 401k, you can contribute pre-tax dollars, which helps reduce your taxable income.
Exactly. And then there are Roth IRAs, where you contribute after-tax dollars, but your withdrawals in retirement are tax-free. If you expect your tax rate to be higher in retirement, a Roth can be a smart choice.
So it's like paying taxes now to avoid paying more later?
That's a good way to look at it. And don't forget about required minimum distributions, or RMDs, which kick in at age 72 for traditional accounts. You have to start withdrawing a minimum amount, which can affect your tax situation.
Right. So planning for those withdrawals is crucial to avoid a big tax hit.
Exactly. And it's also wise to consider how your investments are taxed. For instance, long-term capital gains are taxed at a lower rate than ordinary income. So holding on to investments for over a year can save you money.
That's a great tip.
And let's not overlook the importance of diversification within your investments. It's not just about having different asset classes, but also diversifying within those classes. For instance, if you're investing in stocks, you might want to include both domestic and international stocks.
That makes total sense. It seems like the more diversified you are, the better you can weather market fluctuations.
You got it. And, another thing to consider is to keep an eye on your expenses. Budgeting in retirement can help you avoid overspending and running out of money.
Yes, and tracking your expenses can also help you make adjustments when necessary.
Right. And don't forget about having an emergency fund. It's good to have some liquid assets available for unexpected expenses, so you don't have to tap into your investments at an inopportune time.
That's really practical advice.
It is, and it all ties back into having a well-thought-out plan. But, despite all these strategies, there are common pitfalls that people can run into.
Oh, definitely. What are some of those?
Well, one major pitfall is underestimating healthcare costs in retirement. Many people don't account for those expenses, which can add up quickly.
That's a big one. I think a lot of people might overlook that.
Yeah, and then there's the risk of outliving your savings, especially if you retire early or live longer than expected. That's why planning is so crucial.
It really is. I think we've covered some solid strategies today.
Absolutely. And it's important to revisit and adjust your plan as your life circumstances change.
Well, I think that's a wrap for today's discussion.
Agreed. So one of the most significant pitfalls I see is something called sequence of returns risk.
Right. That's when the order of your investment returns can really impact your portfolio, especially if you're withdrawing money from it during down years, right?
Exactly. Imagine this scenario. You retire, and in those first few years, the market takes a dip. You're withdrawing funds for living expenses while your investments are losing value. It can really derail your retirement plan.
That sounds stressful. Do you have an example of someone who faced that?
Sure. I had a client. Let's call him John. He retired in 2008, right before the market crash. He had a solid nest egg, but was relying on it to fund his retirement. When the market declined, he had to withdraw more to maintain his lifestyle, and it really hurt his long-term sustainability.
Whew, that's tough. So what did he do after that?
Well, John had to adjust his spending, which was difficult. He ended up delaying some of his travel plans, and it took him a while to regain that sense of financial security. The lesson there is, you really need to have a withdrawal strategy that considers market volatility.
And that's where a well-structured withdrawal plan can help.
Exactly. Another common mistake is ignoring taxes when planning withdrawals.
Right. I think many people underestimate how taxes can eat into their retirement income.
Definitely. For instance, if someone decides to draw heavily from their tax-deferred accounts in their early retirement years, they can inadvertently push themselves into a higher tax bracket.
That's a tricky situation. Do you have a real-life example of that?
Absolutely. I had a couple, let's call them Tom and Linda, who retired and began withdrawing large sums from their traditional IRAs. They didn't realize that by doing that, they were significantly increasing their taxable income, which resulted in them owing more in taxes than they anticipated.
That's frustrating. But how did they recover from that?
They had to reassess their strategy. We looked at diversifying their withdrawals, balancing between taxable, tax-deferred, and tax-free accounts. This way, they could minimize their tax liability while still getting the income they needed.
That makes sense. And speaking of things people might overlook, healthcare costs are another biggie, right?
Oh, without a doubt, many people underestimate how much they'll spend on healthcare in retirement. A lot of folks think Medicare will cover everything, but there are still significant out-of-pocket expenses.
I've read that healthcare can be one of the largest expenses in retirement.
Exactly. I had a client, Sarah, who thought she had her healthcare costs under control. But after a couple of unexpected medical issues, she found herself facing bills that wiped out her savings.
That's a tough lesson to learn. How did she cope?
We worked on establishing a health savings strategy moving forward, and she also looked into long-term care insurance. It's all about preparing for those unexpected expenses.
And longevity. That's another factor, right? People are living longer, and their money needs to stretch further.
Yes! And that's where people can really misjudge their financial needs. I once worked with a gentleman named Mike who retired at 62. He planned for a 20-year retirement, but he ended up living into his 90s.
Wow, that's a long time. Did he have to make any adjustments?
He did. Mike had to cut back on his lifestyle and rethink his spending habits because he hadn't planned for such a long retirement. It was a real eye-opener for him.
So how can someone spot these red flags early on in their retirement planning?
Well, I'd recommend regular check-ins with a financial advisor. Look at your portfolio performance, your withdrawal strategy, and your spending habits. If you notice your expenses creeping up or your investments underperforming, that's a sign to reassess.
And what about asset allocation? I imagine that can play a huge role too.
Absolutely. A common mistake is being too conservative or too aggressive with investments in retirement. I had a couple, Bob and Nancy, who were overly conservative. They kept a large portion of their assets in cash, thinking it was safer.
That sounds like it could limit their growth.
It did. They missed out on potential gains. When we adjusted their allocation to include some equities, they were able to find a balance that suited their risk tolerance while still allowing for growth.
That's a great example of how important it is to keep your investments aligned with your goals and needs.
It is, and it's also important to review your Social Security claiming strategy. Many people claim too early, which can significantly reduce their lifetime benefits.
Right. Do you have a story there?
Sure. I had a client named Karen who claimed Social Security at age 62 because she wanted the immediate income. Later, she realized that delaying her benefits could have boosted her monthly income significantly.
That must have been frustrating for her.
It was, but we worked together to create a plan that allowed her to maximize her benefits moving forward. It's all about striking a balance, looking at your needs today versus your needs down the road.
So to wrap it all up, it sounds like the key takeaway is to have a comprehensive strategy and stay flexible.
Absolutely. Retirement planning isn't a one-and-done deal. It's an ongoing process. By being proactive and regularly revisiting your strategy, you can address these common pitfalls before they become major issues.
And for those listening who might feel overwhelmed by all this, what's the first step they can take?
Start by evaluating your current financial situation. Look at your expenses, income sources, and investment allocation. Then consider consulting with a financial advisor who can help you create a tailored plan that fits your unique needs.
That's excellent advice, David. Taking those steps can really make a difference in ensuring a secure retirement.
Exactly, and remember, it's never too late to make adjustments that can improve your financial future.
So true. All right, let's transition into some next steps for our listeners.
All right, so let's dive into some immediate steps that folks can take to avoid running out of money in retirement.
Absolutely. I think the first thing we should mention is reviewing your current financial situation. You know, just getting a clear picture of where you stand right now is so important.
Exactly. Yeah, one of the best tools for that is the retirement calculators available on websites like Vanguard, Fidelity, or Schwab. They can help you assess your savings and estimate how long your money might last based on your spending habits.
Yeah, those calculators are pretty user-friendly. Just plug in your information, and they can give you a solid estimate. Plus, you can adjust your inputs to see how different scenarios might affect your retirement savings.
Right. And, you know, it's also a good idea to check your Social Security benefits. You can do that at ssa.gov. They provide a clear breakdown of what you can expect to receive, which is super helpful for planning.
Oh, definitely. And don't forget about tax planning, too. Using tax software can help you understand how taxes will affect your withdrawals in retirement. Like, some withdrawals are taxed differently, and being aware of that can really make a difference.
That's a great point. And while we're on the topic of practical tools, I'd recommend checking out financial planning apps as well. Apps like Mint or Personal Capital can help you track your expenses and see where you might be able to cut back.
Those apps are fantastic for budgeting. And speaking of budgeting, I think it's important to develop a habit of reviewing your portfolio regularly, right? Maybe quarterly?
Absolutely. A quarterly review can help you stay on track and make adjustments as needed. Life changes, markets change, and it's crucial to ensure your investments align with your retirement goals.
And running retirement projections is another great habit to get into. Just taking the time to run those numbers can give you peace of mind and help you adjust your strategy if you need to.
That's so true. It's all about being proactive rather than reactive. And if you're feeling overwhelmed, don't hesitate to reach out to a financial advisor. Getting professional advice can really help clarify your options.
For sure. And if you're looking for some reading material, there are some fantastic books on retirement planning. The Total Money Makeover by Dave Ramsey is a classic. And How to Retire Happy, Wild, and Free by Ernie Zielinski offers a unique perspective on enjoying life in retirement.
Those are excellent recommendations. And there are also some great podcasts out there. The Retirement Answer Man by Roger Whitney is one that comes to mind. He covers a wide range of topics that can really help listeners feel more confident about their plans.
Oh, I love that one. And I think the key takeaway here is that it's never too late to improve your retirement plan. Whether you're just starting to think about it or you're already in retirement, there are always steps you can take.
Exactly. Small changes today can lead to big differences down the road. It's all about making informed decisions and being mindful of your financial health.
So true. And I think a lot of people underestimate the power of consistent habits. Just starting with a small step, like reviewing your expenses or checking your investments, can really set the stage for long-term success.
That's such a good point. And remember, it's not about being perfect. It's about making progress and being willing to adapt your plan as you go along.
Yes! And sometimes just having a clear action plan can alleviate a lot of stress. So even if you feel overwhelmed, just take it one step at a time.
Well said. And for those who feel they need more structure, there are plenty of financial planners who can help you create a personalized roadmap to retirement.
Exactly. And before we move on, let's remind our listeners that they should also keep an eye on their healthcare costs. That can be a big part of retirement planning that often gets overlooked.
Absolutely. Healthcare can be one of the largest expenses in retirement, so understanding what your Medicare options are and planning for out-of-pocket costs is essential.
Right. And just like we've discussed, staying informed and proactive can really help you avoid any surprises down the line. So with all these tools and steps, you're well on your way to strengthening your retirement plan.
That's the spirit, and it's all about taking control of your financial future. So with these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today. Well, Emily, as we wrap up, I think there are some key takeaways that really stand out from our discussion about avoiding running out of money in retirement.
Absolutely, David. First and foremost, having a solid budget is so crucial, right? It's all about understanding your expenses and income and adjusting as needed.
Exactly. And it's not just about the numbers. It's about making sure you have a clear picture of what your lifestyle will look like and how that aligns with your financial resources.
Right, and then we talked about the importance of having a diversified investment strategy. It helps to spread out risk and can lead to more stable returns over time.
Definitely. And let's not forget about the role of Social Security, which can be a vital part of your retirement income. Timing your benefits can really make a difference, can't it?
Yes, it can. And we shouldn't overlook the need for an emergency fund. Just in case unexpected expenses pop up, having that safety net is really comforting.
Well said, Emily. It's all about building and protecting your retirement wealth so you can enjoy this stage of life without constant worry.
And remember, folks, planning for retirement is a journey, not a destination. Stay proactive and informed.
If you found value in today's episode, please like, subscribe, and let us know your biggest takeaway or any questions you might have in the comments below. And share this with someone who's planning for retirement or already in it.
Yes, we love hearing from you. And next time, we'll dive into something that affects all of our plans: how inflation impacts your retirement savings. You won't want to miss it.
Until then, take care of yourselves and keep focusing on your future.
Goodbye for now.
Bye.